Like to call this meeting to order. Moved by Councillor Kotick, second by Councillor Rolla. Resolved that the regular meeting commence at the hour of 7 p.m. And be it resolved that council acknowledges that we are meeting in the Superior Treaty, Robinson Superior Treaty area on lands that have been traditionally used by several Indigenous nations. But we would like to pay special recognition to our closest Indigenous neighbors, the community Bigdigon Nishnawbe and Nemizigamic Nishnawbe First Nations. We wish to recognize the long history of the First Nations Métis people in our region specifically and show respect to them today. All in favor? Carried. Any additions or deletions to the agenda? No. Disclosure of pecuniary interest or general nature thereof.
There is one disclosure declaration form. Member of Council Kathy Hudson. Council meeting date April 8th, 2026 in closed session. I declare pecuniary interest on agenda closed session item number 15-01 of the agenda for the above noted meeting for the following reasons. I am the chair of the Manitowoc Municipal Housing.
Thank you. The approval of the agenda. Moved by Councillor Hudson, second by Councillor Kotick. Resolved that the agenda be approved as circulated. All in favor? Carried. Delegations and presentations. Moved by Councillor Rolla, seconded by Councillor Hudson. Resolved that council has been provided a presentation by Doan Grant Thornton, LLP of the Consolidated Financial Statements. Consolidated Financial Statements for the Corporation of the Township of Manitowoc for the year ended December 31st, 2023. Okay, welcome.
Hi, thank you. Just for some background, we're here today to present the 2023 financial statements, and my apologies for not being able to make it at the last meeting, but 2023 required a lot of extra work with respect to some new standards that came into place, so we'll walk through that shortly. So what you have in front of you, you should have two documents. You should have the draft consolidated financial statements as well as the audit results report to council. So I'm going to start by walking through the audited financial statements that are being presented tonight for approval by council. So the first thing is to just maybe I'll take a few minutes to highlight the audit report and sort of just mention and remind everybody what an audit is and what an audit isn't. So when we do an audit, we audit for what we call reasonable assurance, because we can't get absolute assurance. You can't audit what's not there, so you'd never get absolute assurance. And we audit for what we call a material misstatement. We're not saying that these financial statements are perfect and contain zero errors, but what we're saying is that we're comfortable that we've done sufficient work to detect material misstatements. So for example, if there was an undetected misstatement of $20,000 that we didn't know about, that would not be considered material and we wouldn't change our audit opinion. However, if, for example, we discovered a $200,000 misstatement, then we would first approach management and request that they adjust that level of misstatement because it's material. And if for some reason management chose not to adjust a material misstatement, we would actually change our audit opinion. Okay, so when you look at the audit opinion, the work that goes behind an audit opinion involves a different strategy depending on the risk. So it's a risk-based audit approach. At the planning stage, we do some brainstorming and we identify the areas of higher risk. And by default, we spend more of our audit efforts in the areas of higher risk and less audit effort in the area of lower risk. And risk isn't necessarily determined by the dollar value. When we look at the type of work that we do, then depending on the account, we might vary our procedures. For example, on some accounts, we would look at a trend analysis compared to budget, compared to prior year. On some accounts, we might identify a scope and say we're going to test all items greater than that dollar scope. On other accounts, we would put the whole population of transactions into the computer and let the computer pick a sample and test that output sample. Also, we look at your controls sufficient to decide how we're going to execute our audit, but this opinion is on your financial figures. It's not an opinion on your internal controls. And in the absence of an audit committee, then this council is deemed to be those charged with governance. And although we've assisted management in preparing the financial statements and consolidating all the numbers and drafting the notes, management takes ownership of the financial statements themselves. Doane Grant Thornton issues an audit report. So the 2-page audit report is really what belongs to us. And council, as those charged with the governance, takes responsibility for overall approval of the financial statements. So if I read our opinion, it reads as follows. In our opinion, the accompanying consolidated financial statements present fairly, in all material respects, the financial position of the Corporation of the Township of Manitowoc as of December 31st, 2023, and its results of operations, its changes in its net financial assets, and its cash flows for the year that ended in accordance with Canadian public sector accounting standards. So when we refer to Canadian public sector accounting standards, those are the standards that are required to be followed by a municipal government. And in order to issue an opinion, we have to follow the standards. So what you'll notice that these financial statements don't necessarily match your internal financial statements and how you actually budget and how you levy your taxpayers. For example, in your internal budget, municipal budget, if you were to get debt proceeds, you would call that revenue. Well, for accounting purposes, that's not revenue. Likewise, in your budget, if you budgeted for a purchase of let's say a capital asset, a snowplow, you would expense that snowplow as a purchase, where for accounting purposes, it's not an expense, it's a capital asset item. On the flip side, in your internal budget, you don't budget for things like amortization, which is writing off capital asset over its useful life, whereas for accounting purposes, you have to do that. And in your internal budget, you would expense a debt payment on a loan, whereas for accounting purposes, that's not an expenditure. So there are differences between how you budget for tax levy purposes versus how these statements must be presented in accordance with PSAS. So keep that in mind. If some of these numbers don't make sense and you've never seen them before, it could be one of those PSAS, non-PSAS adjustments. And we're going to get into some details later, but there are some significant changes in this year's financial statements as a result of adopting some new public sector accounting standards in 2023. And those standards were required to be adopted under PSAS. They were not a choice you made to do in terms of adopt or not adopt. So if we look at page 3 of the financial statements is the statement of financial position. And this statement reports all of your assets and your liabilities. And your assets are comprised of financial assets. So these are things that are cash or are going to turn into cash at some point. So you've got $14.7 million of financial assets comprised of cash and cash equivalents. So those are just all of the various bank accounts that the municipality has on a consolidated level, including the library. You have some portfolio investments, which is your investment in an entity called One Investments that invests all municipal, it's sort of pooled funding with municipalities. And what you'll notice here is your cash balance is down from the year before, and that has to do with various timing issues with respect to when you collect your receivables as well as when you pay your payables. Your portfolio investments have gone up from the year before, and that's mostly due to having earned income on your bond fund, about $78,000. And also, there was an impairment with respect to the fair value of those bond funds being below your book value or your cost. And as the markets are bouncing back and interest rates are increasing, then you've recovered $72,000 of that previous impairment loss. Your taxes receivable, that's all of the property taxes that are owing to the municipality for both 2023 as well as all prior years, all arrears interest and penalties included in those balances. There was a decrease from the year, there's an increase in the balance from the year before, and part of that has to do with a decrease in the allowance, which is a contra account. So in the prior year, there was an allowance of about $162,000 relating to provisions for township-owned properties, and all of those were applied against the provision in 2023. In 2023, your current taxes represented about 59% of the total balance, while in the year before, it was representing 56%. So it's just showing that taxpayers are taking a little bit longer to pay than compared to the year before. Your accounts receivable is any amounts owing to the municipality by third parties that are not tax related. So this includes everything from non-tax AR, HST receivables, grants receivable, any other amounts owing. And there's a significant increase from the year before, and there's two significant items. The first one is there's about a $406,000 increase in HST receivable. So you pay your HST on your invoices, you get a municipal rebate, you have to apply for that rebate. So in 2022, the HST receivable was just for the last quarter. Whereas in 2023, the receivable was all of 2023 plus the last quarter of 2022. So the balance just grew, and those will come when the rebates get processed by CRA, which happened after year end. And also in the current year, there's 193,000 of OSIF grant receivable for you've incurred the eligible expenses, but the grant money came later. So that is set up as a receivable in 2023. When you look at your liabilities, you've got accounts payable and accrued liabilities. So this represents any amount owing to third parties for either goods received before December 31st or services rendered before December 31st for which you may not have paid you didn't pay the invoice till after. There's really the big increase is just the timing of your payables. The trade payables was higher at year end 2023 compared to the year before, just based on timing of payments. And part of that is just when your batches of check runs are being distributed. You have a small due to the trust funds. Your deferred revenue is comprised of any funds received for which there are stipulations on how you're supposed to spend that money. So for example, your OSIF funding has stipulations, your gas tax funding has stipulations, your NORDS funding has stipulations. All that money, when it's received ahead of having met the stipulation, although you've received the cash, you have to defer, for accounting purposes, defer the revenue until you've incurred that eligible expense. So in 2023, you received $128,000 of gas tax funds, which did not get spent, so they got added to the deferred revenue balance. And there was also some smaller amounts of grants for Earth Day Canada, $38,000, and Trillium Library Renos, $65,000. Again, grants received by December 31st, 2023, but not spent on eligible expenses till after that. So they become revenue in the year the eligible expense is incurred. Now we have this wonderful new item called an asset retirement obligation. So this is something new that you wouldn't have seen in the past. What you would have seen in the past, however, is a liability line called landfill closure and post-closure costs. So what happened in 2023, effective January 1st, 2023, the municipality had to adopt PS 3280 asset retirement obligations, a new standard. And that standard, what that means is that the old standard for landfill, which is 3270, is no longer applicable. And the new standard kicks in. But that new standard covers landfills and a whole bunch of other items that were previously not required to be liabilities. So what the new requirements of the standards now is that when you have an asset and when you become legally obligated for remediation of that asset, then that's when you record the asset retirement obligation. So your asset retirement obligations at the end of 2023 is 3.4 million, and it was restated in 2022 for 3.3 million. So what you'll notice in the top of the 2022 column throughout these statements is you'll see restated note 1. So what that means is the municipality chose to adopt this new standard using the modified retroactive method, which means you go back and you restate the prior years and you take an adjustment to opening accumulated surplus for those prior years. So if you were to put these financial statements next to last year's financial statements, some of the 2022 figures won't match because they've been restated. And we'll walk through note 1 shortly, but effectively note 1 summarizes all of the restatements. So the big change is, although landfills were covered before and they were accrued before as a liability, the method of how you accrue that is different under the new standard. So under the old standard, you had to sort of estimate your costs. You have to estimate the life of the landfill based on annual usage volume. When do you expect the landfill to close? And you're going to estimate closure costs. So you have to future value those costs, and then you present value them to today. And then your post-closure costs is after closure, then you have another 25 years of post-closure maintenance. All of those used to be accrued. However, under the old standard, you would accrue only the liability related to the proportion of the volume of the landfill used. The rest of the calculation was the same, but you would prorate based on if you're 50% use the landfill, then the liability is 50%. Under the new standard, you record 100% of the liability the day you become legally obligated to remediate. So that number has really gone up. So you used to have 1.1, at the end of 2022, you had 1.1 million of landfill closure costs accrued. That's come off the books. And what you do is you replace that with this new accrual on the new method, but that amount is now 2.2 million. Okay. And then the second piece that's new that was never covered in the standards before is asset retirement obligation covers a lot more than just landfills. It covers things like hazardous materials, asbestos in buildings. So the municipality had to go through an exercise of looking at all of its assets and identifying which assets had these types of remediation liabilities associated with them. And again, you record the liability the date you become legally obligated. So it's either the date you acquired the asset, if it was after the late 80s and when asbestos stopped being used, or if you constructed an asset in the old days. If you construct a new asset, there's no asbestos being used, but there could be, right now the bulk of your other liabilities, hazardous materials and asbestos, but there could be other types of things that would fall into the standard down the road, depending on what type of activity you undertake. So that new requirement resulted in adding almost $1.1 million on the books as an asset retirement obligations for those building type hazardous and asbestos type retirement obligations. So that number is brand new and it's a big number. It's a number that you currently, it's called unfunded. You currently don't levy your taxpayers for this liability all at once. But at some point you do have to levy for the fact that you will incur costs to close a landfill and maintain and retire all these assets. So again, a huge change. Now, when you look at 2022 compared to 2023, there's an increase of $124,000. So after implementation of this new standard, then on a go-forward basis, the first thing you do is you have to roll forward that calculation by year for the time value of money. And you'll see on Schedule 3, segment disclosure, you'll see a new line called accretion. So that's an accretion is an accounting expense to show that now that you're getting 1 year closer to having to resolve that remediation liability, the time value of money is taken into account. So your liabilities increases as the clock is ticking and you're getting closer and closer to retiring the asset, the liability is going to increase. Now there's no change in 2023, but going forward, 2024 and all future years, there could be a second adjustment to that amount, which is every year the municipality has to take a look at all of its assumptions regarding costs, inflation rate, discount rate, and revisit that estimate because it is a big fat estimate. But every year you have to revisit all of the assumptions that go into the estimate to see if anything's changed. So for example, if someone had estimated asbestos removal at $1,000 a square foot, and then in the current year you actually remediated property and realized it was $3,000 a square foot, then you would update all of your calculations for the new information that you know today based on anything that's happened. If there's that type of adjustment going forward, then that adjustment doesn't get expensed. That adjustment would be capitalized because the other side of the asset retirement obligation is a tangible capital assets related to the liability. So again, very complicated accounting concepts, but effectively that's what's going to happen going forward. So if you deduct your financial liabilities from your financial assets, you get what's called net financial assets of 8.2 million. So that's a positive figure, which is good news because it means you've got assets to fund activity that hasn't happened yet. Then you get into what we call a non-financial assets. So for accounting purposes, these are assets that are not cash and they're not going to turn into cash anytime soon. And when you look at your tangible capital assets, these are all of the assets. The net book value of 21.3 million represents all of the assets that you've recorded for accounting purposes. And the asset goes on the books at its cost, whether you purchase it or construct it. And then based on the asset's life, you amortize it over its useful life. So this is the net book value of that accounting exercise. It doesn't mean that that's a fair value if you were going to put up a for sale sign and try to sell your assets. However, you're not in the business of selling assets because these are assets includes everything, but it's all of what you need to provide your municipal services to your taxpayers. So it's all of your equipment, all of your buildings, all of your road infrastructure. All of that is included in this number. So during the year, the change in balance, first it was additions of about 1.2 million, but then there was a deduction for amortization expense of 1.6 million. So the net of that is actually a decrease in your overall net book value. The largest additions included about 357,000 for water network, 224,000 for vehicle purchase, 175,000 for street lights, 161,000 for a weather observation system, and $80,000 for fire hydrant replacements. Then you've got some smaller other balances for inventories and prepaid expenses. So at the end of the day, for accounting purposes, you get what we call an accumulated surplus of almost 29.6 million. But I want to take a minute there and pause and jump to Schedule 1 on page 22 of these financial statements. Because it's very important to understand what does accumulated surplus mean for accounting purposes. So the 29.5 million is not money to spend. It's not money available to spend. It's not that type of surplus. So for accounting purposes, for example, this schedule shows the components of accumulated surplus. So in accumulated surplus, you have your reserves and your reserve funds. So your reserves about 1.95 million, your reserve funds 8.4 million. Those are included in the 29 million. And the other big component of that 29 million is your investment in tangible capital assets. So the fact that you account for tangible capital assets creates equity, so to speak, in your capital assets. And 21 million of that 29 million is sort of equity tied up in your assets. Again, not money to spend, but it does create an accounting surplus. So the number that's of importance from the municipality from a budgeting perspective would be what's called the general fund, the 1.3 million. That's the item that you would take into your budgeting, but you've got unfunded amounts like your asset retirement obligations of 3.4 million. Those are things that reduce your accumulated surplus. Again, just taking a minute to understand that the 29.5 million accumulated surplus is not the same as an annual surplus, and it's not the same as a budget surplus. Any questions on that page before I move to the next one?
Don't see none.
Okay, so we'll go back to page 4, which is a consolidated statement of operations and accumulated surplus. And again, just remembering that these won't match how you account for things internally because of the public sector accounting standards differences. But effectively, here's where you report your revenue as well as your expenses to create an annual surplus or deficit for accounting purposes. So you've got your taxation revenue along with your user charges, and then your government transfers. And the biggest variances are really coming through in the government transfers section with respect to there's items that you would have budgeted for that didn't take place during the year. So for example, your Government of Canada, that would be your gas tax money, but there was no project that used up gas tax money. So again, that amount is being deferred. So it's not revenue until it's spent. And in your province of Ontario, your 2023 budget kind of mirrored your 2022 actuals. But there was $270,000 in 2023 that was earned from your OSIF funding. So funding received plus interest accrued on prior deferred balances that was spent. Whereas there was no OSIF funding spent in 2022. You've got your investment income. It has a huge variance from the year before. A couple things come into play here. In the 2023 year, there was about $391,000 earned on your bank accounts with respect to excluding the obligatory reserve funds, and $78,000 from your increase in your market value of your bond funds, and then $78,000 of investment income and $72,000 of improvement or reversal of prior year impairment losses. So that's $542,000. In the prior year was only $60,000 because the interest rates were a lot lower, so your bank accounts earned less interest. So for example, only $197,000 compared to $391,000, as well as an offsetting amount going the other way, which was the bond fund had an impairment loss. You had to write down your bond fund because the market value was lower than cost, and that was about $195,000. So there's a significant variance there, and it's just how things worked out with respect to your bank account and your bond fund. When you look at your expenses, total expenses of 9.1 compared to a budget of 9.8, the there's, some accounts are over, some accounts are under, but when we look at the significant variances, you'll see in your transportation services, your budget is a lot higher than your actuals, and that's because there was a budget for various positions that didn't get filled, or budgets that were deemed surplus by the department. However, your 2023 actual expenses are higher than 2022, and that relates to things like increases to the building and maintenance and airport maintenance activity, and more labor allocated to transportation because of those activities. In your environmental services, again, some budgets, budgeted positions that didn't get filled. And then your actuals are higher than the year before because of increased use of contractor support for water and sewer system repairs. Your recreational and cultural services, pretty close to budget, but higher than the year before. And that has to do with there were budgeted positions that were filled, but they weren't there in 2022. So there was extra staffing with required services for golf parks, ski, and recreational administrators that were new in 2023. So for accounting purposes, you get what's called an annual deficit of $734,000. And then you'll notice at the bottom, the accumulated surplus balance has been restated. And this is where you see that opening January 1st, 2023 impact of adopting the new asset retirement obligation standard. So what that led to was an adjustment of $1.8 million to your opening accumulated surplus to restate for the new accounting policies. So you end up the year at the 29.5 million. Any questions on that page? No? Okay. The next page is a statement that you don't see in your internals, but it is a requirement of the public sector accounting standards, a statement of change in net financial assets. And what this does is it explains, so 2 pages ago when we talked about net financial assets, which is financial assets less liabilities, there are items that, for example, use up cash, which is a financial asset, but the acquisition of tangible capital assets, for example, is a non-financial asset that doesn't show up in this net financial asset figure. So effectively, again, this statement's been restated because of the asset retirement obligation liability that's changed because of the new standard. But effectively, this is showing how you would have an annual deficit, but then you would use up your financial assets to acquire tangible capital assets. Likewise, you add back amortization of tangible capital assets because that's an expense, but it didn't use up any cash. It's a non-cash item. So this just explains how you would have started the year at 8,447, and you've reduced your net financial assets by 246 to arrive at the 8.2 million. The next page is a statement of cash flows. Again, another statement that's not in your internal financials, but it is a requirement of the standard. And the purpose of the statement, all of these numbers come from all the previous pages. And the purpose of this statement is to account for sort of how's the cash flowing, because in your annual deficit of 734,000, there are revenues for accounting purposes where you record the revenue before you actually see the cash. Likewise, there are expenses that you record for accounting purposes before you pay the invoice. So based on the timing difference between collecting receivables, making payments on your payables, as well as adding back amortization of tangible capital assets, which is a non-cash item, as well as showing the acquisition of your capital assets, which used up cash, this statement effectively shows how you would have an accounting deficit of $734,000, but your bank balance only went down by $407,000. So it's not a one-to-one relationship, because revenue and expenses don't necessarily match cash flows in terms of timing. So you started the year with cash of 9.4, you've decreased it by 407,000 to end up at about 9.04 million. And now we get into the notes. So if you look at page 7, you'll see note 1, adoption of new standards. So this is the note that if you wanted to compare your 2022 figures to the actual statements last year, this note would reconcile what was previously reported in 2022, the increase or the decrease as a result of adopting the new ARO public sector standard, and then as restated, which is the new comparative figures that are used in these financial statements. So this reconciles all of those numbers. And there's also another paragraph below that, which is financial instruments. So financial instruments was also a new standard that the municipality had to adopt on January 1st, 2023. Now, in this case, the adoption of the standard didn't result in any numerical changes to any of your numbers, but it did result in a whole bunch of new note disclosures, and we'll walk through that in a few minutes. So if I look at these accounting policies, effectively nothing's changed up until you get to page 12. So on page 12, you'll see the new item called asset retirement obligations, and this describes the policy that you have to follow for asset retirement obligations. So that's new. And then on the next page, you'll notice at the top of page 13, financial instruments. So this is the new policy you have to follow. Financial instruments are recorded at cost or amortized cost or at fair value, only if they are portfolio investments in equity instruments quoted in active market, which you don't have any. If you had items at fair value, you would actually see a new statement added to these financial statements called a statement of remeasurement gains and losses, but you don't have to do that because you don't have any fair value financial instruments. Now, if we flip to page 15, note 9. Note 9 is the new note relating to asset retirement obligations. So there's a requirement to disclose sort of the changes in the account balance every year from the year before to show if there's any adjustments with respect to, there's none in 2023, but if there's any adjustments with respect to change in estimates, and then the accretion expense for that annual time value of money. So that note is new and it will continue to be there going forward. And then if you jump to page 20, actually 20 and 21, you're going to see almost two full pages of new notes. And again, although you've adopted financial instruments and there's been no dollar impact on your numbers, there's been new note disclosure requirements regarding risks, risk disclosures, as well as what we call aging of financial instruments. So the timing of when you expect to collect your receivables and the timing of when you expect to discharge your liabilities for payables and so forth. So these 2 pages are new notes. And again, going forward, these will continue to be in the new disclosure from 2024 onward. So before I go into my audit results report, any questions on the statements themselves?
Nope, see none.
The next report is our report as external auditors. In this report, so your financial statements are prepared following the accounting standards. We have to execute our audit following the Canadian auditing standards. And those standards dictate what we have to do, how we do our audits, as well as what we have to communicate to those charged with governance. So this report is the report that officially discharges our responsibilities as auditors to meet those communication requirements. So I won't walk through everything, but I just want to highlight a couple things. So in terms of where we are today, so when this package was issued last week, a couple things were a couple items were outstanding. One of them is the receipt of the signed management letter from management. So management signs back a letter to us, and that was received this morning. And the next one is approval of the statements by council. So hopefully that happens tonight. And then procedures regarding subsequent events. So our audit report date is hopefully today. So we have to update our subsequent events procedures to today, and that was wrapped up this morning as well. So in terms of on page 2, in terms of our risks, summarizing the more areas of higher risk. The first one is just whenever we have, sort of current economic environment that makes us relook at, the areas of uncertainty. You're in an industry, fortunately, right now that has not really had the economic uncertainty hasn't resulted in any changes to your financial statements at the moment, but it's something that you have to look at every year with respect to what's happening, just to make sure that you don't have impairment of assets, for example, or that your internal controls, have exposed, your internal controls are more laxed and you've exposed to errors and so forth. So for 2023, there was no changes and no requirement for disclosures regarding that. In terms of significant transactions, we've already talked about your capital expenditures. And in terms of your most significant revenue line, that is your $1.7 million OMPF funding. That's pretty straightforward because it has no stipulation, so it's revenue when you receive it. When we look at our significant risks, so the first risk is significant risk from revenue recognition. In our standards, this is a presumed risk of fraud. And you have various revenue streams, but we've tagged the fraud risk to the grant revenue stream for a couple of reasons, making sure that, that your expenses that you're incurring in order to say you've earned the grant revenue that you've spent it on eligible expenditures. And also that you've met all the stipulations of the grant agreement. So for example, if you have two grants and you're over budget on one grant and under budget on the other grant, is there an incentive to move expenses out of the program that's got a surplus to avoid repaying that unspent government money, for example, if it was that type of grant? So what we do is we look at all the significant grant agreements, make sure we understand what the stipulations are with that grant money, and then we test the expenditures that are being claimed against that grant to make sure that they're actually eligible expenses based on the nature of the project, for example, or that they're in the right period. So we had no exceptions there. When we look at our second risk, another presumed risk of fraud in the auditing standards is what we call management override. And what that does is really cover the risk of journal entries. So you can have really, really good controls over things like who can approve an invoice or purchase order, who can sign checks, who does the bank reconciliation. You can have all of that good stuff. And then at the back end, by journal entry, management can move things around to affect the reporting. Okay. So for example, moving the money between a grant surplus and a grant deficit to avoid repaying a surplus. So what we do is we look at journal entries to make sure that there's a business reason for the journal entry and to make sure that the journal entry is not being used to manipulate financial reporting. So we had no exceptions there. And then we look at fraud and legal acts. If we become aware of anything, that we would obviously bring it to your attention, and we're not aware of anything with respect to fraud or legal acts. So on page 5, we've already talked about the adoption of PS 3280 for asset retirement obligation and the dollar impact that that's had on your financials. Page 6, again, we've talked about the adoption of financial instruments with respect to no accounting changes on adoption, but a lot of new note disclosure. And then page 7, we talk about estimates. Again, estimates aren't always black and white. There is some judgment involved in estimates, but there could also be management bias in an estimate. So what we do with estimates is to make sure that the estimates are reasonable and that the assumptions used in the estimates are reasonable. So the two most significant estimates relate to tangible capital asset. The asset itself is not an estimate because you paid for what you paid for it, but it's useful life. So how you amortize the asset over its useful life, that useful life is an estimate. So we make sure we look at your accounting policies and we look at your amortization expense to make sure that useful lives make sense. Now, as a result of adopting asset retirement obligations, there are some assets that originally had a lower useful life that now that you're at the stage of looking at it with respect to the asset retirement obligation, you realize, oh, it's going to last longer than our original estimate. So there were some revisions made for assets that are actually lasting a bit longer than you originally thought. And that came out of that exercise with the asset retirement obligation. And then, as we mentioned, the two asset retirement obligations for the landfill closure and the hazardous materials and so forth. All of those, again, we look at all the inputs that management has with respect to cost, inflation rate, discount rate. We make sure that there's no bias used in those figures. And we recompute the balance to make sure that it's reasonable. So no issues there. When we look at the schedule of adjustments, the first page talks about the amounts that were actually adjusted. So these are all the entries that management has agreed to post as a result of completing the audit. But on page 9 is the adjustments that are not being posted. So these are the amounts that are unadjusted. We are aware that they're not reflected in the financial statements, but because they're not material, we are okay accepting these unadjusted misstatements and not changing our audit opinion because the amounts are not material. When we look at the other items, just reconfirm that we're independent because to be the external auditors, we have to be independent. So we confirm that here. And then there are some technical updates at the back, Appendix G and Appendix F, talk about changes to accounting standards and auditing standards. And we've already spoken with management, but in 2024, that we're starting the audit next week, there is a new standard that needs to be adopted. We don't know yet if there's a financial impact or not, but that standard has to do with revenue recognition, PS 3400. That will be applicable for 2024. And what that means is that there could be some adjustments to revenue, unless they're not material again. But effectively, the new standard for any revenue that's not covered by an existing standard for So not government grants, not taxes and so forth, but all the other revenue. There's a new requirement now to only recognize revenue um, when you've completed the performance obligation that you have. So a good example would be building permits. You collect a building permit fee. In the past, you would have called that revenue the day you collected it. Now you have to stop and look at it and say, well, I might have 6 steps in earning that revenue because I have to inspect, I have to do site visits. So I haven't earned all of that revenue the day I collect the money. I have to execute these performance obligations to earn that money. So that's a good example of something that's going to get captured in this new standard. Again, it may not be material, but there may be a change in how you account for revenue that could lead to increases in deferred revenue. So you collect money, you haven't completed your performance obligations to have earned all of it yet, so you may need to defer some of it. So that's going to be a 2024 impact. And Appendix A, just reconfirming everybody's responsibilities that I already spoke about earlier. And Appendix B is just summarizing. So at the beginning, we talked about sort of the riskier areas. Appendix B talks about some of the other areas that, again, they're lower risk, but we do some work on the low risk areas. And then we've attached the audit report that we walked through and the management representation letter that was signed, as well as the appendices with more details if you wanted to read the technical components of that. So that is it for the formal audit results report.
Okay, are there any questions? No. Okay, the only question I had was, when it comes to amortization, is there a standard to follow for the amortization of the length of life for a vehicle versus a piece of equipment versus a building? Or is that just a guesstimate upon purchase?
No, so if you go to page 9 of your financial statements, you'll see your policies are disclosed there. So there are ranges in terms of amortization, but it is based on the nature of so for example, your buildings, most of your buildings, would have a very, very long life at the high end of the 40 years. But you could have, let's say, a smaller building like a shed that might only have a 6-year life. So there is a range at which you fall into based on your policies, and it's going to be specific on that nature of that asset.
Okay, thank you. Okay. Other questions? Okay, well, thank you very much for the presentation. That was a very thorough and yeah. Very thankful that it's done.
Yeah.
Good. Okay.
Thank you very much.
Okay. Thank you. Have a good night.
Hey. That was great. Well, that's sorry. Okay, so we'll go ahead to question here. Okay, and further that upon conclusion of council's review, council does hereby approve the draft version as presented. All in favor? Carried. Okay. Up to the minutes. Moved by Councillor Hudson, seconded by Councillor Kotick, resolved that the minutes of the regular council meeting held March 25th, 2026 are adopted as circulated. All in favor? Carried. Petitions. Correspondence. The reports. Meetings. Moved by Councillor Kotick, second by Councillor Rolla, resolved that the minutes of the District of Thunder Bay Social Services Administration Board meeting held February 19th, 2026 be accepted as received. All in favor? Carried. Okay, verbal update. all I really have for the verbal update is I want to say kudos and thank you very much to all the staff and the volunteers that put on the slush cup this past weekend. I heard it was a blast, and for those ones that were that brave to go ski across water at -9, you know, not something I would do, but I'm sure next year, if we have it at the same time, it's going to be above zero. So it'll be a lot nicer there, but it's great to see that Manitowoc, you know, the people that we have put on events that, you know, it's the only place you see it in the region. So very proud of that. So that's all I got. Anything, yeah,
No.
okay. Okay, over to business. Moved by Councillor Hudson, second by Councillor Coddick. Resolved that council is in receipt of administration report PW 2026-01 submitted by Tyler Brewster, Director of Public Works, regarding Public Works Facility Locker Room Rehabilitation, pre-budget approval. Welcome.
Thank you. So through the chair, this project started, you know, a couple of years back. We budgeted 200,000 originally for an upgrade. We ran into some significant obstacles along the way, as I outlined in my report. So what we're looking at this year, be a total of, so we budgeted 200,000 last year. It didn't get done. So we're looking at a $240,000 on top of that for a total of 440 out of the infrastructure improvement reserve for this year. You know, so you guys have the report in front of you. If you have any questions, I'd be happy to answer them. That's all I got. Okay.
Through the chair, so in the report, it states that TBT Engineering was engaged to support the design and tendering process.
Yep.
Is that where this dollar value has come from, is through that process?
Yep, that's correct.
Okay.
The project has been put out to tender, and that's what has done that.
Okay, thank you.
Any questions? All I got to say is I'm sure that building is well need of some upgrades.
Yep.
And it's nice to see that, you know, it's for the betterment of the employees actually to be a lot more comfortable, and glad to see, because that building's got to be 50 years old.
50 years old, and again, just, you know, with these upgrades, the challenges are getting everything up to standard, right? So when we pull into this, it's like, oh, well, we need a new washroom. Well, that comes with accessibility standards, you know, all the above, right? So, proper heating, all that. So it is a big improvement, and I think it's very important to the staff to see that we're moving forward with things like this, and it'll help retain people, you know, and having a nice place to come to work is very important. And I think it's something we need to provide.
Absolutely. Okay, I have no issues with it. No other questions? Okay, and further that pre-budget approval in the amount of 240,000 be granted for the upgrade of the locker / lineup room, covering the cost of TBT Engineering Services and the completion renovations. All in favor?
Through the chair, sorry. The mistake there was I budgeted 200 last year, asking for an extra 240, just because it's all this year's pre-budget, it would be pre-budget approval for the full 440,000. Because, so we budgeted 200, but we never used it. So just,
That still be there.
it's still there, but because it's pre-budget for 2026. The funds are there, as in we haven't used it, but this is gonna be coming out of the 2026 budget. It'll be the full 440,000. If that makes sense.
Yeah.
Yes, that's right. So
Aaron,
just
would you please clarify?
So for clarity, what Director Brewster has presented is a request for an additional 240,000 for this project.
Yes.
In addition to the 200 already budgeted. So the budget amount that will show up in the 2026 capital budget will be 440,000.
Correct, but we have already approved the 200.
That's right, but the 2026 capital budget is not approved. So, and we don't have a policy that states that budget amounts are automatically rolled over to the next year if not used. So the correct figure is technically 440,000.
Okay,
Technicality more than anything else and housekeeping.
perfect, thank you.
Thank you.
Thanks.
Okay, all in favor? Carried. Thank you.
Thanks.
Your next. Moved by Councillor Rolla, second by Councillor Hudson, resolved that council is in receipt of administration report CS 2026-01 submitted by Brad Law, Ski and Trail Supervisor regarding the Manitowoc Recreation Trails Advisory Committee 2025 Progress Update, 2026 Work Plan. Welcome, Brad.
Good evening, Mayor and Council. So as the report has been given to you, I'd like to give a little bit of an update of what we've gone through in the 2025 year with trails and what we're hoping to look for the 2026 work plan. So last year was a phenomenal year with trails. We managed to purposely put everything up to the public to use through signage and our construction builds and everything. We had a great working staff with no assist was great. Really extended to a lot of programs as well. Both through the program of the Tuesday Trails hiking program. And other collaborations with Ontario Superior Country. They have been very excellent with us to work as far as promoting Manitowoc and everything that we have here through ski trails, whatever we have to offer. So been really great. As you've seen in there, like we have our trailheads that have been completed with all the information to help with liability and safety and awareness while you're on the trails. And they kind of span all the way through the town. And we're only looking to further that. So this year with new workers and everything, we're hoping to further extend what we have through our already about 24 kilometers worth of trails that we are hoping to have completed by the end of this year, really. With a above average snowfall this year compared to our last ones, we definitely have plans on key areas that we have not really been accounted for yet. And what I mean by that is flooding areas. You know, the last couple of years have been pretty snowfall, so we have some key areas that we're looking at to see where flooding really happens, and we will increase those trail uses for springtime and through all great. It's all great for the summer, but you know, the springs, if they last a long time, you get marshy areas, and we really want to try to improve some of the key areas there. So as far as like the 2026 work plan goes, is we're looking at really increasing almost year-round use of that by building small little key features in areas that we have, as well as expanding it further into crown and whatnot to really, you know, grow what we have in this area. On top of that, yeah, like I said, a lot of great work has been done, and from the pictures that you see in the report, like there's definitely some night and day differences. We really tackled a very large area, which we're excited to promote this year once it's complete. A lot of the hard work was done with the trail cutting of itself. The big difference with this, it took us a while because most of the areas that we had to cut to were by foot. So a lot of the areas that we've done before in the past, through 2024, we were able to kind of get to with the four-wheelers or the side-by-sides, drop people off of key areas and really move pretty fast. This most recent one, which is up by the old CBC Tower area and whatnot, that doesn't really have the access point for that. So we have to start at one point of the trail, carry all of our gear in, get far, and then go to the backside of the trail. So, and with not being touched in many, many years, it was really overgrown, as you can see in the pictures. So the team that we had, a lot of hard work, a lot of steps were put in that year, and with great success. So we're really looking forward to finally pushing that out one there for the public to see. One of our next big ones that we're also hoping to do is to help promote them further with pamphlets and on the apps and everything, right? So we have apps that are lined up. It's just a matter of taking some time in the spring and whatnot to really pass that information on to the apps themselves, and then getting that updated and then informing the public about it. And the great thing with these apps is all hiking ones are free, very easy to use, you pretty much GPS pinpoint yourself on the trails, so. As far as anybody getting lost or whatnot, it really saves on that. Plus it promotes it by people uploading pictures and everything, so again, another further promotion that many hikers will use and hopefully come to town. So, anybody else, any other questions regarding the report or anything I can further explain on? Yeah, me too.
Question?
I do, it's just about one of the pictures. So the logbook and the Willow Rapids,
Yes.
what is the logbook about and where exactly are those rapids?
So the logbook, what we would like to do is put in the multi-use trails plan. To help with funding, what we really would like to do is try to increase what our numbers are. A lot of provincial parks kind of have a logbook to show how many people are coming from out of town and using
It's
it.
kind of like a guest book type.
Exactly, yeah, so it's we made our own cases the best that we could, but the books themselves are actually waterproof. A lot of them are used out in nature and whatnot, so it's not like it's gonna really deteriorate or get ruined by the water, so that's the plan for there. We want them at each major trailhead, so that way there, hopefully, you know, if we see a great use that people are signing in, especially from out of town, we can take that into further funding. Again, one of the big things that's really coming up is mountain biking. And with mountain biking, you actually do a lot of multi-use trails. So it's expensive to do and there is lots of funding out there for it, but we just it's too wild to increase that. And the Wilroy Rapids, that is within the new one, so some people may recognize it as Wilson Falls. So in that area, it is within the old Pump House Road. Along Pump House Road in the far end of the lake. If you kind of follow the creek that goes from Chico, it is along that way.
Okay.
So we've kind of renamed that area. The Manitowocz Lake Trail System, and we've put a lot of key features in with the old Chico Wilroy mine, because there's still old pipelines and everything that actually run along there. Most people, like, you can actually get most of the distance by four-wheeler to the Wilroy Rapids, and it's a short, maybe 100-meter walk to actually get there, so, yeah. With everything else, once we actually, there's still some key safety features that we want to get finished off that weren't last year, to really make sure that that trail is compliant. So it's gonna be our main focus as far as the start of 2026, to try to get that one all. Because that whole area there is extremely beautiful. The ice falls within that trail system. So it's a great time to see it now, and it's large, it's daunting, but it's very rewarding. Lots of up and down, but like very great views of the town and the lake and different areas, so. And again, that was a lot of work to do, with all the students that we had, and I think once we actually get it posted and out there, I think people will be really happy with it.
Perfect, thank you.
Yeah.
Okay, my only question is, you're talking about all the snow melting and, you know, with the extra snow we had.
Yep.
So are you talking like monitoring the trails as it's melting to see, you know, where the low spots are, where you might
Yeah.
need walkways and that type of thing?
That's exactly it.
Okay.
So a lot of, when you get to certain hiking trails within the area, they do have like temporary walkways or small wooden structures, whatever, that kind of lift that area up. So we do have some key spots already identified. But with quick drawing and the springs that we have, we understand where they are, it's gonna be expanded, so that might even mean certain areas might have to have specific detours at the time, if the areas are too large. There are a couple areas that we're talking about within the new trail system that possibly flood out hundreds of meters of it. So we might have to look for detour routes, but again, the last couple of years, we haven't really had the water or the melt to really show where they are, right? So to make it feasible, I mean, everything costs money, especially lumber and everything, so if it finds that we close the trail off for a specific set of months and then realize, okay, it's been 2 months now, we still have maybe 50 feet or 100 feet that are low, okay, well, we can focus on something like that instead of having to think, right? And then you still make a detour, which will allow the trail use as you see it's from.
Yeah, well, this year will be a true test.
Yeah.
For sure, so, okay, that's, no other questions, thank you very much.
Thank you.
Okay, and further that council accepts Manitowoc Recreation Trail Advisory Committee 2025 progress update 2026 work plan as presented, all in favor? Carried. Ellen. Okay, bylaws. Right, no. No. Where we at? Oh, here's no, sorry, here's no bylaw. Okay, full session. Moved by Councillor Koenig, second by Councillor Hudson, whereas section 239(4) of the Municipal Act 2001 SO 2001 C 25 provides that before holding a meeting or part of a meeting that is to be closed to the public, municipality or local board or committee of either of them shall state by resolution the fact of holding of the closed meeting and the general nature of the matter to be considered at the closed meeting. Now therefore be it resolved that this meeting is hereby closed to the public as the subject matter being discussed falls under the following section. Section 239(2)(c), a proposed or pending acquisition or disposition of land by the municipal or local board. Land disposition, all in favor? Carried.